Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sinofert Holdings Limited annual report. Sinofert Holdings Limited offers a diverse range of businesses and services across the fertilizer industry. At its core, the company provides various types of fertilizers, including potash, phosphate, biocompound, special, and nitrogen fertilizers. In addition to these basic products, Sinofert also offers sulfur, crop protection, seeds, monocalcium, and decalcium phosphate. The company's services extend beyond just production and distribution. It provides technological research and development for crop nutrition business and products, as well as trading in fertilizers. Furthermore, Sinofert develops agriculture products and manufactures and sells feeds. The company also engages in the exploration and exploitation of a phosphate mine, further diversifying its operations. Overall, Sinofert Holdings Limited's businesses and services encompass various aspects of the fertilizer industry, from production to research and development, trading, and mining. Sinofert Holdings Limited maintains a market capitalization of $11 billion, broadly in line with the industry peer group. Sinofert Holdings Limited trades at a lower price-to-earnings ratio of 7 times and a lower price-to-book ratio of 0.85 times relative within the industry. This suggests a potential market detachment, as Sinofert Holdings Limited trades at discounted levels, while the broader industry remains fairly valued, warranting deeper fundamental analysis. The company maintains a moderate leverage profile, with liabilities making up 50% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 3.87%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth for the company can be attributed to several key factors. Technological innovation in nutrient efficiency, biofertilizers, and soil health has been a significant contributor to revenue growth, with a 14% year-on-year increase in biological fertilizer sales. The increased proportion of photovoltaic power application and resource utilization of solid waste and green transformation have also contributed to the company's revenue growth. The launch of new products, including BioPlus products, has been another major driver of revenue growth. The diversified supply system for potash fertilizers through international cooperation and the increased sales volume of biological potash fertilizers, Whitefang, have also played a crucial role in driving revenue growth. In addition to these factors, the company's specialty fertilizer operations, new product launches, crop protection synergy business, and seed synergy business have all contributed to revenue growth. The increase in bulk raw material costs and industry consolidation and capacity constraints have been identified as potential drivers of revenue decline. Overall, the company's revenue growth can be attributed to a combination of technological innovation, new product launches, and strategic partnerships. However, the company must also navigate challenges, such as increasing raw material costs and industry consolidation, to maintain its revenue growth trajectory. The net income of the company experienced a significant increase, rising by 18.66% year-on-year to RM$1,259 million. This growth is also reflected in the net income margin, which increased from RM$0.1511 to RM$0.1793, representing an 18.8% rise. The profit margins of the company have been deemed healthy and stable due to continuous improvement in profitability. Specifically, the overall profit margin increased by 0.42 percentage points to 5.41%. However, there were some variations across different business segments. The basic business saw a decrease in profit margin from 8.6% to 8.6%, while the growth business experienced an increase from 10.5% to 10.5%. The gross profit margins also showed improvement, with the basic business increasing from 6.4% to 8.6%, and the growth business rising from 7.7% to 10.5%. On the other hand, the production business segment saw a decrease in profit margin for some of its operations, while others remained unchanged. Overall, these changes indicate that the company has been able to maintain healthy profit margins despite fluctuations across different segments. The company's financial performance indicates a significant improvement in its ability to generate cash from operations. The data provided on pages 125 and 126 shows a substantial increase in operating cash flows before movements in working capital, as well as cash generated from operations. In 2025, the company reported RMB 1,888,095 in operating cash flows before movements in working capital, which is a notable increase from RMB 1,622,156 in 2024. Furthermore, the net cash generated from operating activities also shows a significant improvement, with RMB 2,311,000 reported in 2025 compared to RMB 1,441,000 in 2024. This indicates that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and ability to meet its obligations. The data suggests that the company's efforts to improve its operational efficiency and reduce costs have paid off, resulting in increased cash generation from operations. The significant increase in net cash generated from operating activities in 2025 compared to 2024 further confirms this trend. Overall, the company's positive operating cash flow is a testament to its financial stability and ability to sustain its growth trajectory. The company's debt level and interest expenses have undergone significant changes. In terms of debt level, the total interest-bearing liabilities decreased by 19.41% from RM 1,870 million to RM 1,507 million. The total debt level also saw a decrease from RM 1,870,216 to RM 1,507,279. Furthermore, total bank and other borrowings decreased from RM 1,816,546 to RM 1,482,989. However, the interest expenses have shown mixed results. On one hand, interest paid increased from RMB 55,240 in 2024 to RMB 43,060 in 2025, but this is a decrease of RMB 12,180. Additionally, interest on borrowings decreased by 21% from RMB 54,503 to RMB 43,216. On the other hand, interest expenses at 31 December 2025 increased significantly from RMB 25,763 at 1 January 2025 to RMB 45,083. Furthermore, interest expense to related parties also saw a decrease from RMB 8,312,000 in 2024 to RMB 6,231,000 in 2025. In conclusion, while the company's debt level has decreased significantly, the interest expenses have shown mixed results with both decreases and increases observed across different periods. The company's performance across various segments and regions has been mixed. On the positive side, the basic business segment and production business segment have seen an increase in revenue from the previous year, with profits of RMB 874,069 and RMB 404,457 respectively. The biofertilizers segment also reported a significant growth, with sales volume increasing by 14% year-on-year. In contrast, the growth business segment has experienced a decline in revenue compared to the previous year. Furthermore, the elimination segment incurred a substantial loss of $8,929,079 in internal revenue. On a more positive note, the Asia-Pacific and Europe regions have reported profits of $346,823 and $387,441 respectively, indicating strong performance in these areas. Management's current focus is on driving the company forward through agricultural modernization and technological innovation. This includes advancing the Bio Plus strategy, which integrates research, production, and marketing to create a seamless operating system. The emphasis is also on digital service innovation, risk management, and green agricultural planting technology. In addition to these initiatives, the company is prioritizing green and sustainable development, with a strong commitment to QHSE, quality, health, safety, and environment management, and ecological environmental protection. This approach not only benefits the environment, but also enhances the company's long-term competitiveness. Management has identified cybersecurity as a strategic priority, recognizing its importance in protecting the company's assets and maintaining customer trust. Furthermore, the company is committed to responding proactively to market dynamics and industry trends, ensuring that it remains adaptable and resilient in an ever-changing business landscape. Overall, management's outlook is centered on innovation, sustainability, and strategic partnerships, with a focus on driving growth while minimizing environmental impact. The company's financial history reveals a commitment to rewarding its shareholders through dividend payments. According to the provided summary, the company has indeed paid dividends in both 2024 and 2025. The exact amounts for these years are specified as 314,759 RMB and 525,339 RMB respectively. A closer look at the company's financial records, as mentioned on page 127, confirms this information. This transparency suggests that the company values its shareholders' investments and is willing to distribute a portion of its profits back to them in the form of dividends. There are concerns about inventory buildup or supply chain disruption evident throughout the report. On page 12, price volatility for critical agricultural inputs is mentioned, indicating potential difficulties in securing stable supplies. The accelerated restructuring of global production and supply chains on page 22 suggests a complex and challenging environment. The procurement strategy outlined on page 32 involves strategically procuring key fertilizers, which may help mitigate some risks. However, the inventory balance increased by RMB 605 million on page 37, indicating potential overstocking. The inventory turnover days were also faster than the previous year, suggesting that the company is holding onto inventory for longer periods. Geopolitical conflicts and price fluctuations of international energy and core fertilizer raw materials are causing significant pressure on procurement costs, page 43. Rising raw material prices, port price fluctuations, and extreme weather events are further exacerbating these challenges, page 81. The actual amount exceeding the annual cap for purchase and sale of agricultural products and fertilizers under various agreements, page 108, suggests that the company may be struggling to manage its inventory levels. The increase in cost of sales by RMB 648,771, page 118, is likely a result of these supply chain disruptions. The 13% increase in fertilizer merchandise and finished goods from 2024 to 2025, page 177, indicates that the company may be experiencing difficulties in managing its inventory levels. Overall, while some measures are being taken to mitigate risks, there are significant concerns about inventory buildup and supply chain disruption evident throughout the report. That concludes the financial summary for Sinofert Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.